It's a wild ride in 2025. Listen up, investors. 2025 is throwing us curveballs. Trump's back at it with tariffs, the Dow's doing the jitterbug up 2,000 points one day, down the next. And don't even get me started on these interest rates. They're as predictable as a roller coaster in a hurricane. In times like these, you need investments that are rocks, not wobbly shopping carts. That's where our contenders come in, SCHD and VOO. These aren't your grandma's mutual funds, they're exchange-traded funds, or ETFs. Think of ETFs like baskets of stocks, all bundled up neatly and traded on the market just like a single stock. They're the superheroes of diversification, letting you invest in a whole bunch of companies with just one purchase. But hold your horses. Before you throw your hard-earned cash at the first acronym you see, let's break down these two heavyweights and see which one deserves a spot in your portfolio. First up, we've got SCHD, the Schwab US Dividend Equity ETF. This bad boy tracks the Dow Jones US Dividend 100 Index, a collection of 100 rock-solid companies with a history of paying out juicy dividends like clockwork. We're talking big names here, folks. Think Verizon, Coca-Cola, the companies your grandma knows and trusts. Now let's talk numbers, people. SCHD boasts a 3.5% dividend yield. That means for every $100 you invest, you're pocketing an extra $3.50 per year just for being a shareholder. And get this, they've been growing those dividends for 13 years straight. This ain't no flash in the pan, folks. This is consistency you can count on. But wait, there's more. SCHD also comes with a low expense ratio of just 0.06%, meaning they take just a tiny sliver of your investment as a management fee. That's more money in your pocket, baby. Now for the challenger, VOO, the Vanguard S&P 500 ETF. This one's for all you growth junkies out there. VOO tracks the S&P 500, the index that represents the 500 biggest, baddest companies in America. We're talking Apple, Microsoft, Amazon, the titans of the tech world driving the future. And boy, has this rocket ship been soaring. Over the past 5 years, VOO has delivered an annualized return of 15.11%. That's right, your money could have grown by over 15% each year. Of course, past performance isn't a guarantee of future returns, but it shows you the kind of explosive growth potential this ETF has. But here's the catch. VOO is not for the faint of heart. It's heavily concentrated in tech stocks, which can be volatile. Remember the tech bubble? Yeah, nobody wants to relive that. All right, let's get ready to rumble. In this corner we have SCHD, the Dividend Dynamo, known for its stability, juicy dividends, and low fees. And in the other corner, we have VOO, the S&P 500 rocket, fueled by tech giants and promising explosive growth. Let's look at the tail of the tape. Dividend yield. SCHD comes in at 3.5%, while VOO offers 1.3%. 5-year annualized return. SCHD delivers 11.9%, but VOO edges ahead with 15.11%. And when it comes to expense ratio, SCHD is at 0.06%, and VOO is even lower at 0.03%. As you can see, both ETFs pack a punch. SCHD delivers a knockout dividend yield, while VOO boasts higher growth potential. So, which one should you choose? Well, that really depends on your individual needs and risk tolerance. Are you looking for a steady stream of income? Do you prioritize stability and want to sleep soundly at night knowing your investments are in rock-solid companies? Then SCHD, my friend, is your champion. But maybe you're young, hungry, and ready to ride the wave of tech innovation. You're comfortable with a little more risk in exchange for the potential for outsized returns. In that case, VOO is your rocket ship to the moon. Remember folks, there's no right or wrong answer here. Both SCHD and VOO are fantastic ETFs that can form the core of a diversified portfolio. The key is to understand their strengths and weaknesses and choose the one that aligns with your personal investment goals. Now go out there and make some money.